Welcome back to the channel, folks. This is Jason, the host of Fighting Words Financial. Today, I brought on a good friend of mine, Amar Shah. He is the founder of Client First Capital. He's a certified financial planner and a chartered financial analyst. And today, we're going to talk about top 5 tips to minimize your taxes and things that are especially applicable for this year, because a lot of folks that watch my channel have probably made quite a bit of money this year in the stock market, may have had some challenges earlier in this year and taken out withdrawals from their 401k under the CARES Act or something like that. So we're just going to cover a couple of ways that, or a couple of things that you need to keep in mind to help reduce your taxes.
Sounds good, Jason.
Excellent. So why don't you take it away from here and talk to us a little bit about the blog post that you put up last week on the Client First Capital website.
Yeah, and one of the things that we can do is we can link that in the show notes for you if anybody watching would like that brochure. But essentially, we created a brochure for tax tips within investments. So this is not like, should you take this deduction? Should you take that deduction? Should you depreciate a rental property or something like that? This is strictly around publicly traded investments. And the first tip that we had was taking advantage of long-term capital gains rate. So if you look at the maximum income rate right now, it's 37% on the federal level plus your state income. Mm-hmm. That is what you would pay if you had short-term capital gains. The option to delay that to 365 plus 1 allows you to trigger something which is called long-term capital gains rate. Now, the highest long-term capital gains rate today is 20% plus 3.8% for Social Security, Medicare surcharge. But, for the most part, your long-term capital gains rates will traditionally be lower than what your ordinary income taxes are. So,
right. Now, that highest capital gains rate, though, only applies to folks who have incomes over a certain threshold, correct?
Correct. So okay. for most people, their income tax rate will be anywhere from 24 to 32%. 22, 24, 32%, somewhere in there. And then for most people that are in that range, their capital gains rate will be 15%.
Right. So, I mean, that's for the general public watching out there, your capital gains rate is probably 15%, unless your income's over, a couple $100,000 a year.
Yeah. And so one of the things that you want to kind of address or look at is that if you have a position that you have a significant gain in, how do you lock in that gain and make it long-term capital gains, right? And so one of the things that we do at our firm is that we will buy options on an index that is similar to that security. So this is just an example. This is just for educational purposes only. But let's say you own the S&P 500 and it's gone up quite a bit this year from the time that you bought it, short-term gains, and you think it's at the top end of the range and you want to kind of lock in those gains, but you want to pay long-term capital gains. Well, one of the things is you can protect it by buying options on the Russell 1000, for example, and you can do that for a date range that will make the contract date and the long-term capital gains rate for the S&P 500 match up to 1 year. And that way you can push it out there, and then at the end of 1 year, if the S&P 500 went down, the Russell 1000 typically will go down as well, and then you have some protection there. And if the S&P 500 goes up, well, you're not going to really participate 100% in that upswing because you have the cost of that option.
Right. So you're talking about creating an options collar around a particular security to protect your gains over the long term and allow you to push out the sale of something longer than 1 year, so you can take advantage of long-term capital gains.
Yeah, and essentially, depending on how much insurance, think of options and securing an asset value as insurance, right? If you think about insurance, you pay a premium. Depending on how much premium you pay, you could have a tighter lock into that value. You could have some upside and some downside. Just depending on how much you want to lock in that share value.
Okay, excellent. So a lot of the folks that watch my channel have investments in electric vehicle stocks and things like that. This is actually something that you may want to consider. I know that everyone is kind of filled with a little bit of irrational exuberance right now around the electric vehicle market, and everyone thinks everything's going to go up indefinitely. But I think owning an options collar around your EV investments right now might not be such a bad idea to limit your downside if one occurs.
Yeah, and if you look at the volatility specifically with some of these electric vehicle companies, like if you pull up a chart of Tesla, for example, I mean, it's had this roller coaster, and if you feel you're on the top end of that roller coaster, you may want to lock in that value. And that's so the first tip is that understanding the timing of your returns to take advantage of long-term capital gains rate. We see a lot of people that don't do that, and then they pay almost double because they're paying short-term capital gains rate, which is ordinary income.
Excellent. Okay. So let's move on to point number 2 now, where it says understanding investment turnover. And this is for folks who are heavily invested in mutual funds.
Yeah, I would say mutual funds, SMAs, which are separately managed accounts, where you're hiring a portfolio manager to manage. One of the things with these managers is that they're not taking taxes into account, right? They're just doing it as a pure investment piece. So if you have these type of accounts in an IRA or a Roth IRA, it's probably not as big of a deal as we're making it out to be. But if you have it in a taxable account, the average mutual fund had in 2019 for a large cap, the typical turnover was almost 63%. Right? And we got that from a Bloomberg article. And 63%, I mean, those transactions trickle down to you as the end investor, and you'll have to pay capital gains or a qualified dividend. Depending on how it's distributed, you're paying for that turnover. Right. So how we do it is that we have a core satellite approach, but in our core portfolio, we use low-cost index funds. And the reason for that is that you can get a broad asset class mix, and you can reduce your investment turnover within the funds. Typically in an index fund, you'll see something between 20 to 25% turnover or even less, depending on the index. And that will keep that 1099 that you get at the end of the year relatively low. Now, that's not to say that we do rebalancing on our side and that will cause a taxable event, but we can control that piece a lot better than in a mutual fund or a SMA.
Excellent. So point number 3 in this article, I think, is really in a low-key manner, is probably one of the most important things on here, where it says utilize lot-specific accounting. Let's talk about that for just a moment.
Yeah. So let's first give an example of what this accounting is, right? So if you have an investment and you buy it over a period of time, most firms will use average cost basis. So they'll add up all the shares that you have, all the purchase amounts, and they'll divide it, and they'll give you an average cost basis. Right. I would say, and Jason, you can correct me if I'm wrong, but all the big firms that I've worked at, Fidelity, JP Morgan, I bet Schwab, and all the banks too, will use our average cost basis because it's easier to do accounting for.
Yeah, no, yes. They always defer to what the easiest method is, not the best one for their clients.
And so one of the things that we do is we do lot specific. Mm-hmm. And that means when you're purchasing securities over a period of time, each one of those purchases are treated as an individual purchase. And so each one has its own cost basis and time horizon. So if we had a whole bunch, we can pick ones that are long-term capital gains versus short-term if we have to sell out of an investment. If we're doing a donor advised fund, we can pick the ones that have the highest percentage gain, right? We don't have to look at what's the average cost basis, right? We look at which lots have the highest. So you could have some of one security, some of another security, and the average cost basis could be the same, right?
Right. Now, this is actually, for my viewers on this channel, my subscribers, this is actually a huge issue this year in particular. A lot of them either own NEO stock or Tesla stock. It's up somewhere between 600 and 1,000%, depending on when you bought it. And your lots could have very different tax consequences. Say if you bought 1,000 shares in March, 1,000 in June, or 1,000 in July, there could be very different tax consequences for each one. So I think this is a really important point, particularly this year when we've had really outsized gains in a lot of these stocks. So thank you. Thank you very much.
Yeah. And you know, to be fair, I mean, we're not tracking these on spreadsheets, right? We have technology that does this for us, right? And that's one of the values of working with an advisor is that we have access to tools that can catch some of these other things that, you know, if you're an individual investor, you're not going to look at, or it's not going to be on top of your radar all the time.
Excellent. So let's move on here to point number 4, where you say be strategic about which investment account is used to purchase securities.
Yeah. So in the most simplest form, there's 3 basic accounts. There's your taxable account, there's IRA or 401k, 403b, you know, your pre-tax account. And then there's your post-tax account, which is a Roth IRA, a Roth 401k, anything that has Roth in it, right? And the biggest difference between these is how they get taxed. So when we look at a taxable account, every year you get a 1099 for the dividends and interest that you earn. So you get taxed on that. And you also get taxed whenever you sell something. And sometimes it's short-term capital gains, like we explained earlier, and sometimes it's long-term capital gains. The second bucket being your 401k or IRA, money goes into that before tax. So it's pre-tax money. It grows tax deferred. You don't get a 1099. But when you take all the money out, it's 100% taxable at ordinary income rates. And then the third bucket is a Roth 401k, Roth IRA. It's after tax money in, no 1099, so it's tax deferred, and then all the money comes out tax free. And so you want to have proper diversification between these 3 buckets. And depending on your risk tolerance, your asset mix of stocks and bonds is going to depend where you put them, right? So if you want the Roth to have the most amount of growth, right? Because it's tax deferred and tax free.
Okay.
You want your taxable account to be all your buy and hold securities, right? Your IRA is best for income generating securities because you're already paying ordinary income on dividends. You might as well pay ordinary income on everything you take out of your IRA. Now, depending on your risk tolerance and how much you have in each one of these buckets, you're not going to get a perfect fit, right?
Right.
And so there could be some overlap. So like in typically we see that overlap in the IRA bucket where you'll have some stocks and you'll have some bonds to kind of even out your overall position.
Okay. Excellent. All right, let's move on to point number 5. Know when to use tax loss harvesting. And once again, this year, this is probably a bigger deal than it has been in years past.
Yeah, I mean, I don't know. The industry is split on this. I mean, to be honest, every advisor has their own opinion.
Right.
My opinion may conflict with other advisors and so forth. But the key point here is that when you do tax loss harvesting, it is an accounting loss. But what that also means is that you're taking that loss today, you're resetting your cost basis lower. So in the future, when those investments rebound, now you have a larger gap to fill for capital gains. So we focus tax loss harvesting based off of life events. For example, if you have something else going on in your life where you're going to have a large taxable income or large gain from another investment that you're selling, then you probably want to take some losses this year to offset that large gain.
Right.
But if it's a normal year and you don't have large gains and there's no need to offset things, even though you have losses, you probably don't want to take those losses just to show an accounting loss.
Right. Yeah, I think you and I are actually in complete agreement on this. Like it's an accounting method that's useful around certain events, but it's not something that you should depend on or execute on a yearly basis.
Yeah, and I've gotten not into arguments, but I've gotten into discussions with CPAs that tell their clients, hey, take all the losses you can this year so we can deduct them. Well, when we have to rebalance later in the years, then we're going to take all these gains, right? And I mean, it's just a balance of how you want to approach that.
Yeah.
I think that one thing is important to remember is that when you're carrying forward these losses, you're only going to be able to use $3,000 a year unless you have some gains to offset those losses, right?
I said you're saying $3,000 each year against regular income, but you
Regular
can use them
income.
up to the extent of your investment gains.
Yeah, exactly. And so,
Right.
so most of the times, if you match it up with a gain, then you're getting that benefit that year that you need it. And I think that's a better approach over a longer period of time.
Excellent. Now, real quick, before we're kind of done with your article that you wrote now, but I did want to talk about one or two things regarding the CARES Act that was passed this year. A lot has gone on financially for folks all over the United States this year, all over the world, really. And the CARES Act changed how you can take withdrawals from your 401k. So I think I was reading somewhere that's up to 73% of Americans this year who had a 401k took a withdrawal this year. That is an enormous amount. Now, the penalties were waived on that for this year, but that is still taxable income. And that may push you into a higher tax bracket because, as it turns out, a lot of folks that went on unemployment really didn't end up being or having less in the way of income. And they ended up still taking withdrawal from their 401k or their IRA or something like that. I do want to remind people that you do have the option to put those funds back over the next 3 years and to refile or amend your taxes anytime in the next 3 years to get returns on any of the taxes you may owe for this year. But anyway, that's really all the discussion I wanted to have on taxes today. Thank you for coming on. I saw your article. Actually, Lauren, our buddy, pushed it to us. And I thought it'd be great to have you on to talk about taxes. It's not a lot of what I normally cover on this channel, but I want to give all of my subscribers the information that I think is useful for them to help them fight for a better financial future. Thank you very much. This is Amar Shah with Client First Capital, and I will put his contact details and a link to his blog in the description. Thank you very much, guys, and have a nice day.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember, investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Client First Capital LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Client First Capital LLC and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Client First Capital LLC unless a client service agreement is in place.